Hello, everyone. Welcome to the Profit Report. I'm so glad to see so many of you joining us at the Financial Profit recently. Today, we have a very special and exciting topic. We will discuss our latest performance, achieving 30% plus back-to-back quarters, which has now brought our diversified all-weather portfolio's year-to-date returns to over 70%. Also, you'll want to stay with us until the end as we will talk about Q4 and 2026 and also about how I plan to continue to crush the market in future quarters and in the coming years. Despite Q1 2025 being challenging, Q2 and Q3 have been very solid, delivering 30% plus gains. This bullish dynamic has enabled the all-weather portfolio to appreciate by over 70% year to date as of October 10th, 2025. Let's talk about buying when there's blood in the streets. I purchased many high-quality equities, such as AMD, Alphabet, Google, Palantir, Dell, Tesla, Celestica, and others during and around the April bottom, which enabled our portfolio to surge by 33.6% in Q2. I bought the bottom, going essentially all in on high-quality tech and other top momentum names in pre-market on April 7th. Moreover, I also increased several positions on a retest of the correction lows on April 10th. The all-weather portfolio's 33.6% return in Q2 more than tripled the return of the S&P 500. Yet the market clearly wasn't done with its ultra-bullish phase yet, as we saw another spectacular increase in Q3. So while the S&P 500 gained about 7.8% in the third quarter, not quite as high as Q2's 11.6% return, the AWP posted another 30% plus quarter, this time nearly quadrupling the S&P 500 return in this 3-month time frame. So some things we did well, some things we could have done better. And I believe we can certainly learn a lot from several of the valuable lessons that Q3 provided us with. So to optimize future returns, let's go over this most recent quarter to determine what could have been done differently or better. Also, I want to look forward into Q4 and 2026 to ensure that we position the all-weather portfolio effectively to continue to outperform the market considerably as we advance. So let's talk about the top performer in Q3, which were the gold and silver mining stocks, basically. So the gold and silver mining segment was the top performer. This sector had a considerable weight during the quarter and returned about 63% in Q3 alone. Now, I took some profits during the quarter with several stocks appreciating by 50 to 60%. And more even, because I had a Hecla mining position, which ran up by 102% in Q3, which is pretty remarkable. Now, some minor missteps here may have been that I took potentially, active profits just a little bit earlier in some of the names. So I could have maximized my gains a little bit more in this segment. Looking forward, GSMs, which is the gold and the silver mining segment, is at only about 7.5% of my holdings now. Now, I want to say that going into Q3, it was much higher. It was something like 20%, and I believe it went even above 20% during some points in the quarter. So I definitely took a lot of profits very recently around the highs in gold and silver. So I've taken a lot of short-term profits in the GSM space, but I plan to increase multiple positions on pullbacks as we will likely see a correction, and we're probably seeing actually the beginning stages of a correction now in gold and silver mining stocks and the segment in general. Several stocks I am keen on here include First Majestic, ticker AG, Barrick Mining, ticker symbol B, Newmont, of course, and I also like Agnico Eagle Mines a lot. That's one of my core positions in the portfolio, so I will increase that stock on a pullback. And also Hecla Mining is a company that I plan to repurchase as we advance here, but on a pullback. Now, the industrial, material, and nuclear space. Now, this is another segment that did very well. The industrial material and nuclear segment came in second best with about a 39% gain in the third quarter. Top performers here included MP Materials, up over 100% in the quarter. Lithium Americas Corp, LAC, up by 113% in the quarter. Nuclear stocks also performed well, and Albemarle, which is one of my top positions, also did very, very well in the third quarter. Looking forward, industrials, materials, and nuclear made up about 9.5% of my holdings going into Q4. So I want to increase my nuclear and rare earths exposure. I'm looking at stocks like Oklo and Nano Nuclear, but only on pullbacks, on significant pullbacks. I plan to go long Oklo and potentially Nano Nuclear as well, because I believe these are the top two SMR players in the industry going forward. Should be a lot of demand for their products as we advance. In addition to MP Materials, I'm looking at USA Rare Earths, Energy Fuels, and several other high quality stocks with significant potential in the rare earth space. I remain bullish on lithium and may also incorporate several more traditional industrial and material names into the all-weather portfolio. Now, a main reason why I am so bullish on rare earths here is the continued dependence on China for these critical minerals. The US is very far behind. Therefore, these companies like MP Materials, USAR, and others should do very well going forward. So I am quite bullish on the space, but I also want to see some pullbacks here because we've seen some parabolic moves recently in this space. So my diversified technology segment put up a solid 23% gain in Q3. My leading positions included Tesla, did very well, delivering a 40 plus return. Micron had an excellent run in the quarter, surging by about 60%. Alibaba gained 57%. Alphabet increased by 42% in the quarter. So a lot of big winners here. However, they weren't all winners. Snap didn't have a great run, as I took some losses on a partial position. CRM, Salesforce, I was also disappointed in the performance in that stock, so I cut it from the portfolio. Also, Mobileye didn't perform that well in the quarter, but I am keeping my position here, as I believe this company can redeem itself in future months and years, as it can do quite well in the FSD space, and it's very cheap right now. So moving forward, the diversified tech segment came into Q4 at about 37% of holdings, which is actually on the light side for me relative to tech, because I like to have 40, 50, or even 60% high quality tech exposure during these explosive bull market periods that we're in right now. But given that we are expecting a bit of a pullback, and probably in the AI segment as well, I have narrowed my tech segment a bit, but I plan to increase it going forward. So I continue to like high quality tech, as the AI, FSD, EV, energy, robotics, and quantum computing, these revolutions, they continue, and they're likely to continue going forward. And these are the most important technology drivers that are going to be moving these transformative industries much, much higher going forward, basically expanding market shares in all of these spaces. And of course, my favorite name here is Tesla, because it's the global leader in AI, FSD, EVs, energy generation and storage, and robotics, and arguably quantum computing as well. So Tesla is my number one holding in these segments for a reason, and it's the most significant portfolio position for a reason as well. And I plan to increase it more if Tesla declines to about that 400 to the 350 buy-in area, that we could load up the truck again with Tesla stock. So I would like to see a pullback so I could increase my Tesla position to 15%, or maybe even as high as 20% going forward. I also plan to increase my positions on pullbacks in companies like AMD, because it has enormous potential and a lot of space to run in the AI chip space. I like AMD a lot, as it continues to be one of my most considerable positions, and I plan to increase this high quality chip stock on pullbacks. Marvell, Amazon, Dell, and others could also do very well going forward. Therefore, I plan on increasing positions there. And I also like Sentinel-1 as a sleeper AI cybersecurity stock that could potentially double or triple within the next 1 or 2 years. Let's move on to the Bitcoin and digital assets segment. So despite having BTC designated as a core position, I do view this broader segment as increased risk in general, especially now after some enormous run-ups. Therefore, did not have a massive position in this space during the third quarter, typically keeping it around 5 to maybe 10% tops. Still, the digital asset segment did do very well. It provided about an 18% return in the third quarter, so very nice there. Going forward, I've lightened up. I went into Q3 with just about a 3% allocation in digital assets, mostly to Bitcoin, Ethereum, Litecoin, and some Bitcoin Cash. I decreased some Doge. Actually took Doge out of the portfolio for now, but I will increase the digital asset segment on pullbacks. I like to have it at around 5%, as high as 10% during very favorable periods. Right now, we may be about a higher point than a lower point for sure, so it makes sense to keep a lower allocation size here now. So let's move on to energy because it also did very well. The energy segment delivered a 17% return in Q3. It was primarily limited to several oil services providers, but they did do very well, and a few independent oil and gas exploration and production stocks. APA Corp and Baker Hughes delivered more than 30% gains in the quarter. Going forward, I went in with about 8.6% into Q3, but I've increased it to about 10% because I bought some Enphase. So I plan to increase my energy basket because oil is extremely cheap right now. I don't believe oil will remain around $60 a barrel for a long time. And easier monetary policy, higher inflation, as well as robust demand and potential output cuts should be beneficial for oil prices in 2026. I believe that many of these, badly beaten down oil and gas stocks can double or more in the next 12 to 18 months. Moreover, I like select solar energy here. I think solar has been beaten down too much due to slowdown in housing, high interest rates, and unfavorable government policies. However, lower mortgage rates as well as lower interest rates in general should benefit high quality solar stocks like Enphase, First Solar, and Tesla, of course. Defense had a very solid run in Q3. Some of our defense related stocks did very well in the third quarter. For instance, L3 Harris provided a 20% plus gain. I also locked in a 40% gain on a partial red cat position. Northrop Grumman, Rocket Lab, Joby, and other stocks also put up 20% plus gains in the third quarter. We had some that didn't do so well, like Intuitive Machines and Vertical Aerospace, but those were just short-term kind of pullbacks toward the end of the quarter. I didn't buy those around high points. So going forward, defense was about 14% going into Q3. I recently took some more profits in some of these more speculative defense names, so it's down to about 10% now. While most of the holdings are, quote, traditional stable defense stocks like Northrop, General Dynamics, and Boeing, and others, I still have several higher risk reward companies in my defense space like Archer, Joby, Red Cat, and Kratos actually sold out because it just went way too high. It had a blow off top. I expect to get back in a bit lower, maybe $80 or cheaper. Okay, so moving on to biotech and pharma, the worst performer actually. The biotech and pharmaceutical segment underperformed with only about a 2.7 Q3 gain. I purchased Centene, but I wasn't patient enough with it, unfortunately, and sold it too early, which in retrospect was a bit of a mistake. Really not much to talk about in this segment about in Q3. However, moving forward, I do like this space because I actually like a lot of the high quality biotech and pharmaceutical stocks that have been badly beaten down. This segment has been stomped on basically due to unfavorable policies from the new administration, and it may be time for a turnaround now. So I purchased several biotech stocks toward the very end of the quarter, including Regeneron, Amgen, and several others that actually, had a very good showing at the end of the quarter and are continuing to do well here in Q4. And I plan to increase my holdings in this segment going forward because I think that biotech could do well. I've increased my cash position recently to about 15 to 20% just because I do feel that there's going to be a more significant pullback in future weeks. So that's something that we should definitely consider some takeaways from Q3. Q3 was a very interesting quarter. It seemed like we could see a nice broad market pullback or a correction even, but it never really materialized. Still, I remained very long and fully invested most of the quarter, doing some rotation and adjusting positions around crucial peaks and troughs. That's where the outperformance came from. I had a lot of gold and silver mining stocks in the quarter. However, I took some profits earlier than I should have, which actually limited some gains. I believe the GSM segment would have achieved about 80% return in Q3 if I didn't sell any of my mining stocks along the way. But still, we had a very solid 60% plus, I think 63% plus gains in the segment. So that's very solid. I'm very happy with that. And we also have to consider that the money rotated away from those stocks, went into other segments that could have returned even more than the gold stocks would have. So the bottom line, setting up for another solid quarter in Q4. While some things could have gone better, Q3 was another very solid quarter. Despite some minor issues, the all-weather portfolio, the AWP, increased by about 31% in the quarter, bringing its 2025 three-quarter gain to 60.44%. And now the S&P 500 returned about 13.7%, and the Nasdaq increased by roughly 17.3% in the first 3 quarters of this year. This dynamic illustrates AWP's 340% outperformance over the S&P 500 and a 250% outperformance over the Nasdaq in the first 3 quarters of 2025. Moreover, Q4 also got off to a very solid start, and the AWP's year-to-date gain is about 71.5% now. Yet, I do believe that the market may be ready for a transitory pullback, correction, and a consolidation phase as well. However, that does not mean that Q4 won't be another very solid quarter. Despite the possibility for some near-term turbulence, I am keeping my S&P 500 year-end target at 7,200, and I'm raising my full-year AWP return target rate to 80% from the previous 70% rate. Thank you very much for watching my profit report. I genuinely hope you enjoyed it, and more importantly, that the knowledge you gain here helps you make more informed investment decisions in the future. I would also greatly appreciate hearing your comments. Please join the conversation in the comment section below. If you enjoyed my video, please click like, share, and subscribe to my channel so I can continue creating these highly informative and potentially very profitable videos. You can also join the Financial Profit, my exclusive investment community, which is Seeking Alpha's #1 service for proven portfolio profits. So don't hesitate to join our incredible investment community now. Thank you very much for watching. See you next time and have an amazing day.